Is the United States heading towards state capitalism? If so, what does that mean for regular folks like you and I? Let's talk about it. Today, I get into this topic with my guest, David Hunter. This is the Jay Martin Show, where we dissect the greatest minds in geopolitics and finance. Enjoy.
This is Jay Martin.
All right, here I am with David Hunter. David, it's great to have you back on the program.
Yeah, hi, Jay. Great to see you.
Good to see you. Okay, so I want to start today by talking to you about state capitalism. Here's what I'll say. Recently, we've watched President Trump negotiate some interesting deals, right? First of all, with Nippon Steel and U.S. Steel, he initially vetoed this merger and then allowed it with the contingency that they would be rewarded. The U.S. government was rewarded with effectively a golden share, which gives them a lot of influence over the company's U.S. operations. And more recently, with the NVIDIA AMD deal, now the U.S. takes a 15% cut of a certain chips that are sent to China. We also watched the sort of demanding of the ousting of the Intel CEO, which hasn't materialized yet, but he's still pushing for, and more recently, obviously, the dismissal of the BLS chief. Now, here's my question. Supporters would say, look, the NVIDIA deal, the Nippon Steel deal, that's his negotiating prowess. He's securing better deals for America. That's what we hired him to do. And in terms of Intel or the BLS, he's draining the swamp to some degree. That's also what we hired him to do. The counterpoint to that might be that while these deals seem a bit novel in American politics, they're not at all novel in Chinese politics. This is often and frequently how business is done. State creep into private enterprise to influence the outcome. Now, a generation ago, the assumption was that if China liberalized, the economy would look more like America. And I'm wondering, could today we make an argument that the opposite is becoming true? State creep into state capitalism in the U.S. What's your take? And then I'll pull on some threads.
Sure. Yeah, I mean, clearly Trump's different than anybody we've ever had. And he's not a pure Republican or pure conservative. He actually, in most of his life, was probably socially liberal at least. And so we are seeing that. We know he's a deal maker, so that's mostly what you're seeing. Yeah, there are times when I'm not as comfortable with some things, particularly his efforts to get Jay Powell out of there. I think he should leave that to Bessent, and I don't think Bessent's uncomfortable with what's going on. So I think you also have to look at where we're coming from. He's trying to reverse 40 years of very bad policies and correct some things. He's smart enough to know second time around, I don't have a lot of time. I may only have 2 years. I may have 4. But, my leverage diminishes as we go through this administration or as we go through this term. So he's trying to get a lot done in a hurry. He cuts corners, I think, and if he can get a deal, he's not looking for the perfect deal. He's looking for something that moves us in the direction he's trying to accomplish. And so I'm certainly not uncomfortable with what he did with Nippon Steel. I mean, the reality is you're getting new capital into an industry that needs it. U.S. Steel itself wasn't going to be able to do that. I don't think Cleveland-Cliffs really could have done it. So he's doing it, but he's also, obviously his big interest is to get capital into this country and get manufacturing back where it was in this country. So he's willing to cut corners and give Nippon ownership as long as we have some control over that. So I'm comfortable with that one. The tariffs really is a case of trying to fix something in a hurry. You have to kind of step back and let it work. He's basically, whether he's right or wrong, he's looking at 2 goals. One is to reduce the deficit, get revenues in here, and the other is to bring manufacturing back here and open up other countries to the way we've been open. So I think if you understand his goals, you get a little bit more comfortable with his approach. I can understand people being uncomfortable with it. I don't really think we're going to see this as a long-lasting policy after he's gone. I don't think J.D. Vance will necessarily pursue the same kind of thing. Trump is half the world leader and half still somebody who learned how to negotiate in real estate. So you're seeing both of those things at work. Whoever we get in to follow him, I don't think will pursue anything close to these kind of policies. I mean, the policies will be the same, but the efforts, the tactics will be different. But will be more traditional.
Yeah, that's an interesting take. I appreciate that, because whenever I watch, the reason I ask the question is because whenever I watch these sort of novel developments occur in politics, and we've seen them up where I live, over the last few years, I always have to ask, is this a standalone event or is this new precedent, right? And more often than not in politics, if it's some kind of a power grab, it's new precedent because the door has now been opened for future successors. And the problem with that is that if the party you voted for opened that door, maybe the next one in the seat is going to be the party that you didn't vote for, right? And similar influence, power, and strategy, but with the opposing party supporting policies you do not like, right? Is that a risk, do you think?
Certainly a risk. I think the bigger, where I draw the comparison to what you see up in Canada, I'd say is more in Congress, where you see the Senate, everybody on our side, on the right side of the equation wants Senate to do whatever they have to do to accomplish the goals. And the Senate pushes back and says, if we do that and set a new precedent, as soon as we lose power, we're opening the door for the other side. So I see there more of that, where if we break precedent, if we do something, it's going to come back to haunt us on the other side. The problem is the left seems to be willing to break whether we do or not. So I'm not sure whether that makes sense or not. It becomes the whole end justifies the mean thing, and that doesn't always work out.
Yeah, well, it's a tricky situation, right? Because if you were to simplify sort of the global economy right now as a competition between the United States and China, you have one economy that doesn't have to wait for political will. They don't have to wait for popular support. Any policy can be pushed forward, and it's run like a business, right? Like my company is not a democracy, right? I set the strategy, the vision, and we hunt that down, right? America, thankfully, has a handful of checks and balances in place to prevent that outcome, but as a consequence, moves a little bit slower. And so, I find myself cheering for the cut corners, to be honest with you, because the bureaucratic process has become too much. Right. It's important to have those checks and balances in place, but it's gotten out of hand. Obviously, maybe. What's your take on that, David?
Yeah, I agree with that. Again, it goes back to, I think Trump has a limited time horizon to correct an awful lot of problems and excesses in our society and our country and in our economy. So I do generally, and maybe it's just because he is doing what I want, or the goals are what I want. I generally support what he's doing. I do understand the slippery slope at times, but frankly, the other side has, if we talk about corners that have been cut, there have been so many corners cut over the last, certainly the last 20 years, that have changed this country in very negative ways. Trying to bring it back is not easy. I'm not a big one that, the media loves to go out and poll everything and think that the popular opinion is what matters. Sometimes it's not, because they've spent so much time under basically an agenda that they're not aware of what really is happening. And we're moving very swiftly into a point of no return. If not for Trump, if not for him winning this election, I think we would have really seen us go socialistic, and maybe, unfortunately, global world order would have won. This is, I think, our only hope to push back against that. And basically, I think the world's only hope.
So let me ask you about that, because I think you're right. I saw a trajectory of a large number of very unsettling trends occurring, and sort of like the globalization trend, I suppose, to massively summarize. And a lot of that conversation, a lot of those headlines have been muted in the last 6 months. We haven't heard a lot, right? Do you believe that's temporary? Are those forces still at play beneath the surface, waiting out this current president? I know a lot of, if I were the leader of any of the BRICS nations, for example, I'd probably be approaching the current strategy as we have to wait 3 or 4 years before we can really get aggressive. But it's only 3 or 4 years. America thinks in 2 or 4 year cycles. We think in forever terms, right? Yep. And so it's just a waiting game. We're playing the long game. We know what's going to happen back in the West. You know, what always happens. What's your take on that, David?
I would agree with that. I think it's certainly still there. They have taken a big step back, not by choice, but Trump has really turned things around in a lot of places, but particularly in Europe. But he certainly hasn't turned it around in your country yet. Carney is one of the lead globalists for sure, and so I think some are laying in the weeds, others are still not understanding the game, at least in the short run, has changed. Carney, I think, thinks he has leverage when he doesn't. But, and that's basically Trump is using leverage where he hasn't. He understands our market is his leverage. And our military might, at least in the West, is his leverage. But, when it goes, when it comes to China and to Putin, he finds out he can only push so far. They know they have some leverage too. So, but I do think, once he's out, I think they truly believe that once he's out of there, we can, pick up our agenda where we left off. Maybe we have to take a step back, but we're not going away. So they're by no means put to bed.
Yeah. Right. Okay. I want to get into maybe the China and Russia dynamic in a minute here, but just sticking with domestic issues for a second. The BLS headlines this week. So Bureau of Labor Statistics came out with jobs numbers 3 months ago, revised those dramatically last week. And there's always a revision about 3 months later. That's normal, but this revision was huge and led to President Trump accusing the agency of manipulating the data to make him look bad and ordered the dismissal of the chief. Now, I think the Bureau of Labor Statistics is very archaic. I looked into how it operates, and I was shocked, to be honest with you, that they're conducting surveys, people calling people in terms of, there's sort of two main data points they focus on. One is, are you employed or not employed? They call about 60,000 people. So that's the sample size. 60,000 people in a country of 360 million seems crazy to me, right? And they also call employers, and they call about 650,000 employers. So a lot more, but the success rate on completing those surveys is like at best 60% because it's not mandatory. It's mandatory in 5 states, but the majority of the country it isn't. And as a business owner, that's like, if that lands on my desk on a Tuesday morning and I got 12 priorities on a slow day, like that's not making the list, right? I might get there eventually. But what happens as a consequence is maybe they get 50, 60% on the initial round. And then 2 to 3 months later, they keep prompting these business owners and they get up to 90%. They claim success rate. And that's why the revision occurs. There's the initial data when they send the surveys out, and then they get more responses trickling in over the consecutive months and then send out revised data on the heels of that. I just want to step back and get your take, David, on this week's developments with the BLS, Trump's decision. How are you interpreting all this?
I have no problem with him removing her. It's his prerogative to put whoever he wants into his administration positions or government positions where he has control over it. I wish he had not gone full bore in terms of, he was sure it was politics and all of that, because I'm not sure. I can't say whether it was or not. What I think people on the other side who want to defend her and say this is, he's all wrong, what they fail to understand is that there are ways to kind of softly get, bias the numbers. So you particularly on the jobs, surveys, you gotta, just like they skew the polls by only polling people they know what they're going to get for answers. So there are ways to skew. When people say, oh, there's so many people involved in that, she's not the one. I'm not saying she did it all, but she was overseeing a flawed process, whether it was political or not political. So I have no problem with him putting somebody in he has more confidence in. I am not a big believer that the jobs number should get the attention it gets every month because it's a lagging indicator. And unfortunately, the Fed pays way too much attention to that. The street pays too much attention to that. So it's not one that I think is a big deal, except that it makes for a lot of good headlines for the media, particularly the mainstream media that has an agenda. They love to kind of take things that they think will make him look bad or make him look kind of crazy and blow it up into a much bigger deal than it is. I mean, I heard Jim Cramer this morning in his typical kind of shtick, trying to compare that with the CPI that comes out of the Bureau of Labor Statistics as well, and saying, well, I no longer am going to pay attention to these government numbers because now I don't know if any of them are cooked or not cooked or whatever. And so I'm only going to use private numbers, or I'm going to look at companies and get my response. Again, it's a kind of an anti-Trump take. Basically he takes every opportunity to kind of make a point that Trump is, not the best president. So there's going to be people out there on both sides. I view it as kind of a non-event. Makes for headlines for a week and then you move on.
Yeah, that's actually the best take I've heard, is that maybe the agency is dated. I think it definitely is. The way they conduct their surveys is archaic, and it's not accurate in today's world. And CPI as well. People literally drive out to shops, check price tags, or they call department stores and ask what the price of a pair of cargo pants. Like, it's amazing how archaic this system is. So does it need to be shaken up? Like 100%. But I think what you said is actually, in fact, we just put way too much weight on these numbers. And that's maybe the bigger, I align with that completely. It kind of drives me nuts when people obsess over the CPI number coming out. And it's like, just look around you. You'll know if prices are inflating, right? And
traders love it. It makes for their job for that day to make their job. I look at trends. I'm not looking at 1 or 2 month numbers. I'm looking at trends. And yes, you want to be able to rely on numbers over time. But we have seen these big revisions lots of other times. And frankly, again, I want leading indicators. I don't want lagging indicators. It's
right.
Focusing in on jobs is going to mean you're going to be guaranteed to be late, which is obviously the MO of the Fed.
Yeah. Okay, so let me ask you then, what are you paying attention to right now in the American economy? And if you were to give it a score in terms of economic health right now, where would you land?
Yeah, I basically am saying that the inflation is trending down. It may have stalled a little bit here. It may get sticky here, but basically I think we're trending towards ultimately deflation, if I'm right that we're heading for a global bust. But I think we may already be in recession, and if we're not, and that will only be known when they go back after the fact and date the recession. So I'm not saying it'll be obvious in the next month, but we could be there already, and if not, we are definitely slowing. And so if the economy is slowing, I think it's going to keep inflation pretty much under control until it rolls further down when the economy really takes a dip. Frankly, people don't talk enough about the fact that we have crude oil at $63 a barrel, down from high 80s, and certainly in the just more recently, it bounced up from 55 to the mid 70s because of Iran, but it's right back down into the low 60s. So I think gasoline and oil are going to help keep inflation moving down, not up. And, I think the economy is trending down. And I think those are much more important stories than, month-to-month data.
Okay, so probably good at this point. I want to revisit your global economic thesis that we've touched on a few times on this show, but I haven't had you on in probably 4 or 5 months. So I'd like to revisit this. If you could just start essentially from the beginning, what is your global economic thesis? And then I'll pull on some threads from there, David.
Okay. Yeah, my view has been and continues to be that the economy is moving towards recession, and that because of the leverage in the system, which is beyond anything we've had in any previous cycle, so far beyond 2008-9, far beyond 2020, We're looking at 330 trillion in global debt. We're looking at quadrillions in notional value of derivatives. So I describe the debt as leverage on the financial system, leverage on the economy, and derivatives as the leverage on the markets. Fixed income, equity, metals, everything. There's so many derivatives out there. And people don't realize we really didn't have derivatives before the mid 80s or late 80s. So we've just exploded in terms of, kind of a tail wagging the dog in a lot of ways. With that leverage in both on the system and on the markets, I believe this is going to be far bigger than 2008-9. So as I say, 2008-9, we almost went over the cliff, but when the commercial paper market froze and GE almost went under. Our policymakers acted just in time and kind of pulled us back from the edge of the cliff. We had a rough, what they call a Great Recession, but we didn't go over the cliff. I think this time the potential is there for us to go over the cliff, meaning I call it global bust, but basically meaning something that leads to lots of bank failures, big bank failures across the globe, probably more so overseas than the U.S. this time because our banks were forced to clean up their act and get, unlevered, deleverage a lot. So they're still vulnerable, and certainly the counterparty risk means that if something happens in the big banks in Europe or, your banks or, over in Japan, our banks are in trouble too. But that's my thesis. Just very simply, the leverage this time around could take what would have been an ordinary recession and turn it into something greater. I'd define a bust as something that'll feel like a depression but not last for more than 12 to 18 months. So the unwind will happen very fast relative to what a depression is. But it will come with a lot of a lot of pain while you're in it. I think the stock market can drop as much as 80% peak to trough. People have a hard time with that part of my forecast now because obviously we are nowhere near that. Seemingly nowhere near that. We're questioning whether we're even going to see a recession. I think right now you can get a very long extension or steep extension to the bull market because I think there's enough buoyancy in the market to allow particularly institutions to believe it's a soft landing. So, but I believe it's going to be a hard landing starting next year. Could even begin by the end of this year. I think as we saw in 2008-9, when things tip over, they can get pretty ugly pretty fast. So you have to be careful not to be lulled to sleep. I remember September of 2008, I was calling for a hard landing and I had no company. The vast majority of economists on the street were saying soft landing, no recession in sight. That was 3 weeks from Lehman Brothers. So things can happen fast, particularly in the financial world. You can think everything's kind of, not that it's great, but it's not bad, and then go from soft landing to hard landing expectations in a hurry. So I don't know if we'll see it that quickly, but that's kind of my guess is that next year is going to be the bust.
Okay. Now, there's obviously some major personalities that agree with that. I think Ray Dalio on a personal level is 100% out of equities. Jeremy Grantham is calling for a 50% correction in the market. Michael Burry has a $98 million short bet against NVIDIA. So, they're all circling the same concept. If this would be so much more severe because of the leverage, and we're looking at sometime next year, walk me through the unwinding process. What will you be looking for to add validation to this thesis or not?
Sure. And before we get there, let me just say where I differ from those three guys and lots of others out there is I'm calling for this parabolic melt up into a top first. So I've raised probably since we last talked, I've raised my targets at least twice. I'm at 8,700 on the S&P this year. 40, where am I? 30,000 on the NASDAQ, 60,000 on the Dow, and 3,400 on the Russell. So if you do the math, basically low 30% gain from here on the S&P, mid 30s gain on the Dow, about a 40% gain on the NASDAQ, and a 50% gain on the Russell. So, and I'm saying that will likely happen this year, and maybe by early fourth quarter even. So I think it'll go parabolic, and we'll cover a lot of that ground in a hurry. So that's the others have been bearish for a while, and I think are bearish on the market, and have really been, as has the street, been skeptical of the market all the way up here. I'm still the bull on the street, the high guy on the street, but at the same time, I'm also probably have one of the more severe bearish calls. So just as a preface, that's kind of it's not straight to bust.
Yeah,
and
appreciate that.
and the reason you can have that is what I said before. I think for at least the next few months, you're still going to have the look of a soft landing. And frankly, I'm bullish on bonds, bearish on rates. So I think in the next, despite today's action, in the next couple months, 2-3 months, you could have rates down well under 4% on the 10-year. And that's going to help housing temporarily, probably help autos, help retail a little bit. So that can give you some of that soft landing look too, is that you're getting some support from lower rates. But then ultimately, I think we are trending towards a recession. That recession then moves towards a bust. So what am I looking for in terms of triggers for the bust? I think, let me step back and say it's not so much a catalyst for the bust, but what gets us to that bust is that leverage plus, I think, central bank policy error. I think the Fed in particular, but really around the globe, there's this tendency to worry about the last war. And they're still all worried about inflation heating up again. So it's going to keep them from, and not repeating the 2008-9 policy. So it's going to keep them, when things start rolling over, there's going to be a reluctance to print money. They're going to say, yeah, Powell's already stated, we're not going back to QE infinity. We're not doing that again. We're not here to support the markets. We're looking at the economy, and we have a dual mandate of inflation and jobs. And, payroll numbers are still okay. They're starting to weaken, but they're still okay. I'm saying this is what Powell's saying. And inflation, we're worried that the tariffs could push up. So they're going to be slow to respond to what is an economy that's softening, I think. And then as we get more clarity on the softening, they're going to be very timid in what they do. The normal response of saying, hey, things are starting to get ugly, we got to print, a couple $1 trillion. As we know, they did $5 trillion in 2020. And their plan is not to do that again. If you ask Powell today, and he was on a lie detector, are you going to ever go back to, printing trillions of dollars? He would say no. I mean, I think, and be very sincere. There are people who think he knows what I'm talking about. No, they truly believe we can't go back there. Now, that'll be different when they finally recognize that they have to do more than they thought. It'll be too late. I mean, they're going to be slow stepping the early part of the certainly the recession, and then the early part of the bust. And they're only going to get to what I call, it's not just, unfortunately, a lot of people on the street, you're either, and certainly retail investors are this way, you're either easing or you're tightening. You're either easing or you're not easing. It's also a matter of right size policy. And I have said for quite a while now, given the leverage in the system and what I think is coming, and again, it's global, I think it could be as much as 20 trillion coming out of the Fed to stop the free fall and turn it around. So we did 3.5 trillion, let's say, in response to 2008-9, over the course of the next several years, QE 1, 2, and 3. And then we did 5 trillion in the pandemic. So that got us up to a $9 trillion balance sheet. We were only at 875 billion going into the 2008 slide. So we went from 875 billion in 2008, fall of 2008, to 9 trillion, 15 years later or whatever. And now we've shrunk it back to, say, 7 trillion. I believe you'll see us up near 30 trillion in response to the bust. But the first half of that bust, they're going to be slow walking it and thinking, yeah, we did a trillion. Oh, we did a couple more trillion. They don't realize, because they have never, this is going to be unprecedented. We've never unwound like this before. 2008 and 9 was the closest. And it's going to take them a while to realize, you do a trillion and you wait a couple weeks and nothing's happening good. You do another couple trillion. You wait another 3 or 4 weeks and nothing's happening good. You do another 3 or 4 trillion. And it'll take them several months to get to a right-sized policy. In the meantime, markets are free falling. Banks are going out of, are going under. We're seeing a lot of involuntary debt liquidation. And we've got so many areas out there where we talk about the leverage and we talk about, I mentioned the numbers on debt and derivatives, but it's also look at what that means. It means all that private equity that's basically leveraged buyouts. All the pension funds that have loaded up on private equity because it didn't have the volatility that the market had. You've got a lot of those things that have kind of come into play in this cycle and have never really been fully tested. So I think you're going to see, a very violent unwind that, I think the bear could go from peak to trough in 8 to 10 months. As I said, I think the economy can go, the bust could be over in 12 to 18 months. So it's not that it's going to be long lasting, but while we're in it, it's going to feel like an eternity.
And it's hard to identify what might be the sort of hair that breaks the camel's back, right? In these scenarios, when everybody is so leveraged and every country is so leveraged, it could be any number of things that is the first domino, causing a tiny liquidity squeeze over here, which causes a bigger liquidity squeeze over there, and then it permeates, right? And that's how these events occur. And so to recap, it's only a matter of time before somebody defaults in some fashion, right? And that's the first domino. That triggers the recession. We expect 8 to 10 months peak to trough after 30% rise of the equity market from today forward. There's still going to be a frothy blow off top, as you mentioned, but eventually bills are going to have to get paid. A deleveraging will begin to occur. And over the course of nearly a year, 8 to 10 months, you expect that's potentially up to 80% correction in the market. Now, the Fed's going to watch this. You believe they're going to be more conservative than they've been in 2008 and 2020. So they're not going to just roll out 10 trillion in stimulus.
Yeah, that's actually, I'd say that's probably the easiest prediction I can make.
Okay, interesting.
It's human behavior. You're looking at, they got criticized, not just Powell, but all the Bernanke before him. Yeah. They got criticized for all the ZERP policy and all the money that was printed. And so they're not going to go back there, or at least they don't think they're going back there.
They don't think they're going to.
If given truth serum, he's being very sincere when he says we're not doing that again. But that's easy to say when you're not in the midst of it. When you're in the midst of it, there is only one tool that they can deploy. Mm-hmm. Nothing else. You can't do it through Congress. You can't do anywhere else. Money, it's happening so fast. The only thing that can help stabilize things is just printing gobs of money.
Yeah, so the search will be for the right-sized policy, as you mentioned. And I wonder, that I love that you said that. That's your easiest prediction, is that the Fed will not respond aggressively right away. They're going to try really hard not to. And immediately my thoughts went to Reagan taking office, right, with bold plans to clean up the government balance sheet. But once he got to office, realized how much harder that was going to be. I think about President Trump's first term, right? promises of draining the swamp, but once you're in the swamp, turns out it's a lot harder, right? When you're in that Oval Office, and it's hard to deliver on those promises. And maybe you're faced with new realities you didn't understand previous to taking that seat, whatever it is. But I found myself wondering, is that, Powell can say one thing today, but in the heat of a 2008 style recession, everything's different, and whatever you thought you might do just doesn't hold up anymore.
Yeah, because right now the worry is if we go back there, we could trigger inflation and make our job so much harder. They're not understanding, and I've said this too, is I don't think there's anybody in the FOMC or anybody in the Fed, frankly, that really understands the magnitude of the risks this time around. Like I said, it's really that debt and derivative story that because leverage can have things happen much faster. And then when you have that kind of leverage, that magnitude of leverage, it can make things so much greater. I don't think anybody's thought through that and understands. I think they think 2008-9 was a one-off, and that, yes, we have risk that it could be something like that, but less. But I don't think anybody's really understanding how close we are to something bigger than 2008-9. And so if it's not even in their mind as a possibility, it's not among their scenarios, they're thinking the risks, he says this all the time, risks are balanced, We have to worry about tipping us into recession versus worrying about inflation breaking out a bit. You have no idea. That's the least of your worries. It's so much bigger than that. And he's not going to, certainly in the next several months, he's not going to understand because the markets are going to be looking like things are okay. And frankly, Powell gets a lot of heat, and I defend him on some of this only because I think people have to step away and realize he's saying the same things that the vast majority of Wall Street economists are saying. They weren't pushing for rate cuts here either. I think Powell is late. I think the Fed is late. They should be easing now. But he's not the only one thinking that they don't need to ease. There's no rush. Things look okay to most Wall Street economists. Mm-hmm. And yet we may be just months away from something that ultimately becomes much bigger than anything we've ever seen on the downside.
And so eventually, and it probably won't be Powell, I suppose, in the seat at this time if it's 18 months into the future. Will have rotated the Fed chair at that point in time?
Yeah, and I get timing off all the time. These are big cycles, and I can be wrong by many, many months. But if I'm right about my guess of when this thing really gets going, it's probably first quarter of next year.
Okay.
So he'll be dealing with it before he leaves his position, I think. Assuming he sticks around for that. But then he'll be handing it off to somebody else. And the biggest part of the money print will be probably under somebody else's leadership.
Which is convenient, right? That allows Powell to deliver sort of on his mandate and leave the seat as the guy who did what he said he was going to do or didn't do what he said he wasn't going to do. And the new chair can then inject this $20 trillion stimulus that you mentioned. So running that forward, that puts us in a sort of new monetary world, does it not? A $30 trillion balance sheet. Rates have to be zero at this point for any. Right. There's no other way around that interest expense. Rates have to be zero, and we're in total sort of monetary dominance. What's that? Any thoughts on that, David? What does that look like, and what's the cycle there? I mean, obviously, my audience is probably like, "That's fiscal dominance. This is the downward spiral and the absolute destruction of the purchasing power of the U.S. dollar." But what's your take on it?
Yeah, so keep in mind, the U.S. is not operating and the Fed's not operating in a vacuum here. It will be proportionally the same story with every central bank. This is a global bust. They'll all be printing at breakneck speed once they realize they have no choice. Again, I think that it's not just Powell. All the central bankers, to one degree or another, are going to be cautious about printing. So they're all going to be behind the curve for a while, and ultimately then have to really race to catch up, and that's when the money starts pouring out. but it's still ultimately the story of all that money. Let's say it's 100 trillion. I don't know what it's, 50 trillion. Is way beyond anything this world has ever seen by magnitudes. The story is that it jumpstarts a recovery for sure, but it also jumpstarts inflation. Now, I think the bust will be deflationary because we're going to be entering the bust at low single digit inflation. So I think we probably almost definitely go into deflation for a year. And then coming out of that means the first year out, despite all that money, you're probably in low single digit inflation. Second year, maybe high single digit inflation. By the third year, you're in double digit inflation on your way to, I think in the US, you could see 25% inflation by early 2030s. So, I mean, the ramifications are huge because rates follow inflation. So if we're going to be looking at, I was a money manager in the early 80s. So, you're looking at interest rates going from zero, and I'll just talk the 10-year. Short rates could be negative, or most likely going to be negative, but you go 10 years zero, and within, say, 6-7 years, you're looking at, 10-year maybe approaching 20%. And maybe in less time than that even. So, we're still going to have the debt. We're still going to have governments having to finance, having to service their debt. And my guess is, I talk about the money, but it's going to be both fiscal and monetary. Obviously, it always is. The Fed will be monetizing new debt. The Treasury will be issuing new debt. They'll be doing all kinds of programs like they did in 2020. And so the Fed will be buying all that debt, monetizing that debt. That means we're at 37 trillion now in U.S. government debt. It's probably going to be north of 50. If we're at 330 trillion now, global debt, both sovereign and private, corporate, everything. It's probably going to be something approaching 450 to 500 trillion. All that debt, or a lot of that debt's going to have to be serviced and refunded, refinanced, et cetera, at higher rates. And, just sticking to the U.S. government, there's no way you can solve that equation if you're looking at interest rates in the double digits and your debt is where it is. We can't service it at 5%, right?
No.
And it crowds out every other thing you can do in the government if you have to. That ultimately, I think it leads to, again, not for several years, but probably by 2033 to 35, I think it leads to a collapse of the financial system as we know it. The Austrians might believe, if I look at Peter Schiff as an example, might believe that this is the end game now, and that that we're heading straight south from here. I believe that we have one more cycle because we have the printing press. As long as you have inflation near zero or below zero, you can print money almost to infinity because there's a lag to when that shows up as inflation. So for the next, when the bust hits, for the next 18 months after that, you have the ability to print money to whatever level you need to. And that's why it's going to grow to what it is, because they're trying to stabilize the system.
Yeah.
But then once it happens, there's nothing you can do because you've waited way too long to back off of that. And once that inflation starts heating up, you're not going to be able to stop it. They're going to fight tightening because tightening means higher rates at a time when they can't afford the rates that they're going to be dealing with. So they're going to be slow to tighten. And as I say, you can't print your way out of it once inflation really heats up, because it's like pouring gasoline on a forest fire. It just makes more inflation. So they run out of options next cycle. This cycle, they have the printing press. Next cycle, there will be no options left.
Yeah. Okay. That's interesting. And that culminates in like the 2035 again. massive estimates. It's impossible to time these cycles, but just making some assumptions and our best guesses. So a couple of things I wanted to ask you off the back of that, and they both come from the same place. What should therefore investors be thinking about in terms of protecting their net worth, protecting their purchasing power, reducing their exposure to counterparty risk? In this scenario, it's the issuer of the currency. And is there upside to be captured? And I've recently been reading a little bit about, life in Amsterdam and life in London, as those empires, quote unquote, collapsed, right? And obviously life in London, the empire didn't collapse, right? The baton was passed over the course of about 30 years. But if you were a citizen of London, you might not even have noticed much in your life changed. And they had periods of immense volatility that actually started way before. I mean, inflation in the UK was like 30% in 1803, but they recovered from that, right? When they lost the American colonies, it triggered massive inflation to the UK. And you could have said this is the beginning of the end for the UK empire, but it wasn't, right? They had their best years ahead of them still. But citizens in London wouldn't have noticed much from a transition of global power when it occurred, right? From the 20s to the 50s. What do you expect the experience to be, the lived experience for the average American, and where should people be looking to protect their purchasing power and find safe haven?
So let's start with getting from here to the next recovery cycle. So you go into this bust. You have to be very aware that for the last, from the mid 80s on, the mantra in the financial industry was, it's time in the market, not timing the market. And that was correct all the way through. It didn't take any genius to put your money in an index fund, and you've probably outperformed most professional money managers in the last 40 years. If you bought back in the mid 80s or any time since and put it in, the index fund, the S&P index has outperformed active management typically. And that's because we were in a period of disinflation where interest rates came down, PE multiples went up, earnings did great, and indexes did great. Going into this, if you listen to your financial advisors, because they're not going to say anything otherwise now, they're going to say, oh, don't bail out. Markets always go to new highs. You just, if you just ride through these things, you come out the other side and you do fine. And they've been right through all these cycles since mid 80s. The problem is that if we're going down 80% or anything close to that, I think the highs this cycle that we make later this year, in my opinion, will probably stand for decades. And obviously, if my dire forecast comes true in the mid 30s, it may be many decades. But so it's going to behoove people to actually go against what the kind of consensus advice out there is, and actually liquidate your portfolios or get very defensive, and meaning in cash and bond. Treasuries will be one of the very few assets to hold up in the bust. If interest rates go from where they are now to zero, holding a long bond is going to be very lucrative. So you can hide during the bust, but it's not in equities. And you could say, well, I'll be in defensive equities like utilities. Well, they're not defensive anymore. It's so much anymore. And frankly, they'll go down less than the market. But if the market goes down 80 and they go down 40, you're not going to be a happy camper. Mm-hmm. And same thing with consumer staples and things. They may go down less than the market, maybe not. But they're not going to preserve your capital. So preservation of capital somewhere later this year is going to be very important. And I should point out, because time-wise, we may not be very far from a top. So normally my own advice would be, nobody's going to call the top. Don't try to be a hero. If you're out 6 months early, you'll be grateful you're out. The problem is, if we're looking at 30 to 50% upside between now and the end of the year, that's typically 3 years worth of returns at least. And so even though time-wise, it's time to say, hey, I'm not taking any more risk, I'm getting out. you're going to be very unhappy if you get out now and miss 30-40% upside. And then knowing psychology the way I do, I'm a contrarian. I've studied psychology a lot, or behavioral economics. Investors that come out today are almost sure, a majority of them, to be drawn back in at the top, because at the top there's not going to be a bell rung. At the top, most institutions that have been skeptical all the way up are going to be screaming that this thing has a long way to run. We just started a new Fed easing cycle. There's at least a couple more years to go. And so if you got out now, you're going to say, hey, I can't afford to miss more of this upside. I just missed 30 or 40%. I got to get back in.
Yep.
I was dumb to get out. And then what do? You just climb back in at the top. So again, I'm not going to be perfect. I'm not going to call this thing precisely the way I'm telling you it's going to go, but I am pretty confident that that's what we're headed for. So the first step is going to be that capital preservation, sometime in the next 3 to 6 months, where you get out, and you don't want to be late. That's for sure, because the first step down could be 25 or 30% down. So that's first step. Then you go through the bust, and as I said, treasuries, FDIC insured savings accounts are probably the things that will hold up the best. My guess is, given what happened in 2008-9, and given how much money is going to be flooding into the system, at some point they will put back that policy of we won't break a buck on the money market, so that they'll basically be ensuring the money market is going to stay whole. So you're probably going to be able to use that, but we don't know that yet, so I can't say that for sure. So it's going to be preservation of capital for the from that peak through the bust. On the other end, and by the way, metals that people think are good defensive things, they're likely to get hit pretty hard. I think it's going to be hard to find many assets that don't get hit hard in a bust. So certainly silver is an economically sensitive metal. It could go down almost as much as the market, 50, 60, 70%. Gold may hold up better because it is something that people run to, so it might only go down 30, 40%, but it's going to go down. And that's not from here. Again, we can talk about my metals forecast later, but I have pretty big expectation before we get there to the bust. So preservation capital through the bust. On the other side of the bust, this isn't the end of making money in markets or the end of opportunities. I believe if you just looking at the U.S., if you look at something close to 20 trillion in new QE, and even if I'm half right, it's only 10, you're looking at a V bottom at some point. So if you go down 80%, you can come back 3 or 4 fold from that. So let's just use 9,000 as an S&P estimate for a top. 80% down gets you to 1,800. You could see the market go up, let's say, 4-fold from that, and that's 7,200. If we peak at 9,000 and go back to 7,200, you're in a secular bear market if that's your high for the next cycle. But you also had a 4-fold increase out of the bottom. So those that think it's the end of the day here when we top out, no, there's another cycle after this one, and there's going to be plenty of money-making opportunities, and most importantly, going to be a lot of opportunities in commodities. This cycle was was led by tech, and up until a year ago, healthcare, and some other things. The next cycle will be a commodity cycle. With all that money printed, and with the reshoring going on, and more of that to come, you're going to see that it's industrials and commodities that will dominate the leadership in the next cycle. I am forecasting oil to go to $30 in the bust, and I think I've been the only right bear out there calling for, I called low 60s when it was over 100. So I think 30 in the bust. I think you could see oil at $500 by the early 2030s. So there's going to be, energy will be a dominant leader. Copper will do very well. Any of the industrial metals will do well. And the precious metals will probably top the charts. I think gold's going to 20,000 by sometime in the early 2030s. I think silver's going to 500 in that time, and I may be conservative. I think they can get hit in the bust, as I said. My targets for, by the way, just to square that circle, my targets for silver pre-bust is 75, and for gold 4,000. So we go to 75 here in the next 6 months or less, and then could go down below 30 again. We could see gold at 4,000 this year, and then go back down under 3,000. But from there, the next cycle, if we go to 20,000 on gold, you can obviously see what that does, and silver 500 from wherever it bottoms in the bust. So there's going to be tremendous opportunities, but it's not in the same leadership that made you your money this time around. And it's sure not going to be in the indexes. Could be in the indexes for, the first year or 18 months coming out of the bottom. But after that, you're going to have a stiff headwind of ever rising interest rates, pushing PE multiples down. So the only things that really work in that kind of an environment, that was kind of the late 70s, early 80s market, is you go into the industries, particularly the commodities, where their price flexibility because of the supply-demand situation means they're able to print earnings or make earnings that stay far ahead of the interest rate gains. So as rates go up, earnings are going up faster. In most of the sectors, earnings aren't going to keep pace with inflation, so your stocks go down.
So, okay, thank you for that. So the commodities run that we're currently experiencing right now, a lot of hard commodities trending at or near all-time highs, and the equities responding in most cases, and in many cases, that trend, and often, it's on the heels of a handful of things. The industry has been starved of capital for 15 years, deglobalization, whatever you want to call it, reshoring, friendshoring. This just decreases our certainty in future supply of these commodities. And so demand will go up and price will reflect that. And that's a trend that you see as long-term. That's going to carry us probably towards the end of the 2030s. We'll have to wait and see, but it's a long-term trend. But in the interim, in these liquidity squeezes, anything with a bid gets sold. And that's why you say, despite having a $4,000 target for gold pre-bust and 20,000 post, in the interim, it may fall by 25%. Same thing with silver, right? We're looking at maybe $75 pre-bust. I think you said 200 or 500 post-bust in the recovery. But in the interim, right, if it's got a bid, it's going to get sold to cover our obligations priced in US dollars. And
remember, everybody, those metals get bought on leverage. So there's going to be margin calls. There's going to be all kinds of deleveraging going on. Yes. And so you get a lot of forced selling in that process. And when you mentioned the reshoring things, what really is the whole thesis around the post-bust period is we've spent decades rationalizing down our capacity in commodities, right? It became, it was overcapacitized in the early 1980s. And we've spent decades kind of getting capacity down. And of course, commodities are something that gets used up, and it gets harder and harder to find more. We discouraged investment in that area, not just the U.S., but around the world, such that, because if it wasn't going to be economically viable in the shorter term, it wasn't going to be developed. So what we're going to have is you have 20 trillion from the U.S. and maybe it's 50 trillion from the world, causing this ramp up in demand because it's combined with this whole reindustrialization that's going to go on. You have the ramping up of demand because that money goes into the system and creates demand quickly. To put on new capacity in commodities takes maybe 10 years, maybe longer. right? And maybe in the shortest cases, maybe 5 years, but you're going to have demand far outstrip capacity for many years, far outstrip supply for several years. So the only thing that can give in that scenario is price. So price goes through the roof, and these companies coin money. And so for a period of time, that's what we're going to be looking at in the next cycle. It's going to be a very different cycle than any of the cycles we've had post the early 80s. It's basically been, I lived through that, but we haven't really had, it's been all disinflation since then. We've had some bump ups and periods where industrials took off and commodities had their day, but just very short spurts, not this long spike that you're going to see next cycle.
Yeah. Okay. David, this has been very interesting. I always appreciate catching up with you. We covered a lot of ground. It's a very fun conversation, and I appreciate your time very much.
Yeah, thanks, Jay. Thanks for having me on.
You will not hear this from most financial advisors, and in fact, the traditional construction of most portfolios in Canada actually inhibits you from benefiting from these 10x stocks. You can find the next 10x stock in the most boring places. Boring, beautiful businesses that create great cash flow over the long term. We recommended this company at 60 cents today, trades at 116. That's 200x where we originally recommended it. Boyd Group traded at $2.30 today, about 222, about 10,000%. If you had 20 stocks in that portfolio, all other 19 companies could have literally went to zero in that portfolio, and you'd still have a tremendous return. You really find the companies, the next 10x stocks, in a down market. When everybody is looking away, when there's blood in the streets, that's a great time to buy. We're looking to make money in the market over the long term. You just need to find a boring, beautiful business that produces returns. The returns to me are sexy, not the situation or the story that you're invested in.